Winter is officially here, I can tell you that, because I've already got my first fever blisters, so sorry for that. Last week we were talking about empowering youth in South Africa, and the term mashonisa came up, the informal money lenders who in township areas can charge up to 30% interest per month. So we thought we'd start looking at this micro lending industry and find out more about it, because I certainly haven't been exposed to it at all. And that's why we've invited two guests into the studio. Welcome to Saijil Singh, who is the lead analyst at Coface South Africa, and Johan Meiring, who's the Chief Executive Officer of Blue Financial Services Limited. Guys, thank you for taking time out to join us this evening in the studio. Nice to have you with us. Let's start with you, Saijil.
Yes.
Microfinance, to me the moron, Mansfield the moron. What is it?
What we're looking at here is a large population group within South Africa who previously did not have direct access to certain financial products. And this has been addressed by a number of new companies which have come into the market and smaller banks, which are now addressing this by offering at exorbitant rates, but micro-lending as such, unsecured debt, small amounts of money to people who previously didn't have access.
Just out of interest, do either of you have any numbers on how many people are not part of the formal banking sector?
Jeremy, it depends on what your definition of the formal banking sector is. There's approximately 18 million people that's economically active in South Africa, of which approximately 50% of those are have good credit records and in good standing, and approximately 50% does not. But it does not imply that the 50% that has got bad credit is not banked in one way or the other. So it really just turns on your definition. If you're saying who can in essence access credit in the normal course of affairs, then it's roughly about 50% of the population, and the other 50% of the population, not really.
Don't qualify in the traditional money lending role. Is that what you're trying to say, or have I read this incorrectly?
100%.
Okay. And those, I would imagine, Saijil, are the people who are then turning to the micro lenders because they can't access the mainstream. But as a result of that, they are paying the price because they're paying the higher interest rates.
Yes, that's 100% correct. The other thing is we have the NCA, etc., that will come and try to assist with this and regulate it. However, people are being exploited. Certain companies are overlooking certain regulations in order to get a big profit at the end of the day.
But isn't that going to be the case?
Jeremy, I think we also possibly just need to clarify. Micro-lending in general in South Africa falls under the ambit of unsecured lending.
Okay.
So in the general definition of micro-lending, you would find that the big commercial banks do unsecured lending. In fact, the banks in South Africa are the biggest providers of microfinance in South Africa. So I don't think it's just a question of saying it is the people that don't qualify for credit that goes to micro-lending. And I go back to what is the definition of micro-lending. So simplistically, a person that accesses a loan, which is unsecured and relatively small, would fall into the ambit of an unsecured or a micro-loan. So
but wait, hang on. There's something I'm not following here. How does a bank, a formal bank, grant an unsecured loan? I mean, surely I have never been to my bank manager and he's gone, yeah, no, just take it, bro. There's the money. Just take it. It hasn't happened. They've always wanted something as security.
Jeremy, I can't comment on your personal situation, of course, but in relation to the general lending in South Africa, there's been a shift away from secured lending to unsecured lending. So we're typically speaking, let's say 3-4 years ago, or slightly more, just before the liquidity crunch in 2007, 2008, the predominance of lending was in the secured space, housing and all these type of things, and people wanted security of some sorts. It has really shifted dramatically towards the unsecured lending in SA.
There's my first point. Now, that to me says that when the credit crunch hit, things like home mortgages and those sort of things, the banks pulled right back on those, okay? They have now had to try and find another way to make their money, and surely they're going into risky waters by going into the unsecured area of loans.
True. But it's also, you need to look at a case of volume. So whereas in the past you would get a single loan of a large amount, which was concentrated on a particular individual. So the risk in that is much greater than having a number of smaller loans spread amongst an entire population group. So it's a case of quantifying how risky it is. It is slightly less risky. However, there is no collateral, so you don't have an asset against these small loans, but you're making a sizable bit of profit in terms of the interest rates.
So essentially you're saying that instead of lending me R1 million to buy a house, and you know that the house is worth 1.5, you're lending 10,000 Rand to, okay, my maths is atrocious, so I'm not even going to try and work it out, to a whole lot of people, unsecured, and you see, this is 6 of one and half a dozen of the other to me, to be honest.
Jeremy, things have also shifted on a little bit from there. Because there's a limited amount of people that you can actually provide loans to in South Africa. If you look at the statistics that's coming out on a monthly basis, banks would open up to 200,000-300,000 new loans or new customers per month. There isn't so many people entering into the market space, which in essence implies there is cannibalizing happening between all the different players in the financial services market, including banks, of course. The net result of that is that the average term of loans have now extended a bit. Now, previously, if you look at a house or mortgage finance, even though you might take a 10 or a 20 or even a 30-year mortgage, the average term of a mortgage loan is around about 7 years. That's sort of the average term.
Okay.
Now, the average term of your normal unsecured loan before NCA was around about 2 years, max 3 years. So sorry, that's the maximum. The average would have been around about 18 months to 2 years, around about there. With NCA, there isn't a specific cap on the maximum term that you can use as long as it's affordable. So what now has happened is unsecured loans have stretched out quite a bit. So currently...
Okay, hang on. Before you carry on, don't forget that thought. When you say as long as it's affordable, who determines the affordability of those loans?
Well, it's in essence between the customer and obviously the provider of the loan. So there's an affordability assessment that needs to happen, which is regulated by NCA, obviously done in terms of NCA. Okay. And typically speaking, what would happen is you would land up with an installment that somebody can afford. Now, the way for me to provide, as an example only, a loan to somebody that's already with a financial institution is to provide the person on the same installment just over a longer term, which means it's a bigger loan. So loan sizes have gone from, let's say, 15,000 being the sort of max type loan, has gone to around about 150,000. So it's not just the case of the unsecured loan as the 10,000 one that you were referring to. Loans are currently available in SA for over 5 years to 7 years at 150,000, where your average term is now stretched to 3.5 years.
Okay, but now, hang on. Is this not making South Africans more indebted?
Yes. Yeah, in general, you're looking at your disposable income really shrinking to some extent, and people are then trying to address this by accessing these loans. The biggest problem you get is you cannot discount retailers as well. They are also providing unsecured loans. Mm-hmm. In essence, if you have a furniture account or a clothing account, it's the same principle. There might not be direct interest attached to it, but it's built into that cost of credit. And disclosure becomes the problem. So while companies can do an affordability analysis in good faith, it's up to the consumer, the man who needs the loan, to fill it in as honestly as possible. And if he does not disclose all the loans, all the retail agreements he has, he then qualifies for debt, which theoretically he wouldn't under the National Credit Act.
But you see, I'm in a bit of a dilemma here, because there are a lot of people, and I'm talking about people who are not financially savvy. And let's take your a rural old lady who doesn't have the financial knowledge, but sees in that shop is something that she can buy for just 30 Rand a month. She doesn't realize how much interest she is actually paying for that. But she just sees the 30 Rand a month. And she says, yes, I can afford that. Those are the people who are sort of being sucked into this whole system and who are really paying the price at the end of the day, aren't they, Johan?
Jeremy, yes. I think the concern to a certain extent is why people are accessing these unsecured loans. And a concern, generally speaking, is if people access unsecured loans for consumption usages. That is inherently dangerous because you're going to consume it and then you're going to continue paying this debt for a period of time after that. So I think the issue to a certain extent is why people are requiring the loan. So a unsecured loan from an educational perspective, from a home improvement perspective, those have got one sense or one direction where it can actually assist you on an improvement in your position. A pure consumption loan, I'm not saying it's bad per se, but a person's got to be careful about it because the potential of debt trap really lies around consumption loans.
Do we have any sort of number on what percentage of people are using these microfinancing options as consumption loans or even to pay back other debt?
It'll be difficult to give you a true statistics.
Okay.
You must realize what also falls into this category is credit cards. So for us to separate it and say this is what people are actually using the money for might be a bit difficult, but the statistics are there. Volumes of bank financing in these particular products, such as credit cards or short-term loans, is increasing and increasing exponentially, and that's where the problem comes in. It's, yes, the consumer is being, not, I wouldn't say exploited, but maybe slightly taken advantage of by exorbitant interest rates. But on the other side, we are getting banks which are taking on risk, which ultimately they might not be able to recover in terms of that debt.
Are you, from your differing perspectives of this micro-lending industry, are you satisfied, because we're going to have to go to a break in a moment, are you satisfied that the National Credit Act has got the teeth enough to control this particular part of the industry, which seems to be just exploding?
Jeremy, I think first of all, the NCA is a very good piece of legislation. I think it does, generally speaking, a good job. There's one concern that a person has on the affordability side. If I go back to my example of you do the affordability assessment and you can afford an amount. Once you can afford the amount, the way to increase lending to you is to extend the term all the time. So there's nothing that really regulates when does it become unaffordable if you stretch the time period too long.
Okay.
And I think there's a concern on my side in relation to that, because what is happening is the amount of unsecured lending is growing disproportionately to secured lending. And the concern to a certain extent is that there's not sufficient money going into housing finance. Of course, the Basel III coming out and its requirements kicking in from next year has also got further implications for that.
We'll get onto that in just a moment. There are a few other issues that I want to touch on as well.